All right, everybody, welcome back to another episode of the Discovering Multifamily podcast. I'm your host, Anthony Scandariato with Red Knight Properties, and this is Discovering Multifamily episode 75. So I want to welcome Eric Schleien to the program. Eric Schleien has a pretty interesting background. He's actually the host of the Intelligent Investing podcast himself, and he's a value investor, one of the founders of Granite State Capital Management. And today we're going to talk about his investments into public. We're talking a lot about private real estate markets on the show, but he's going to have an interesting perspective from the public side of real estate investing. So looking forward to the show and looking forward to learning the insight that you provide. So thanks for coming on, Eric.
No, thanks, Anthony, for having me on.
Excellent. So tell us about your show and tell us about your company. And I want to learn as much as I can from you.
Sure. Yeah. Well, I'll back up and I can share how I got into investing because that's what led to my show and my company. So I started when I was 14 and I was, at a bookstore with my mom and we walked into the Barnes and Noble or Borders, one of those. And, wanted to be a big boy and go to the most mature section of the bookstore and saw the business section. And there was a book that I found, and it was something like, a teen's guide to making more money than your parents. And it was a book by the Motley Fool. And it seemed interesting. So I sat down and just started reading it at the bookstore. And, they have the basics of, the dangers of being in credit card debt and, save more than you make and all that. And then I saw a compound interest graph. And I thought to myself, wow, if I could, compound money for decades, right? Because it was a 50-year graph. I could, have a job where I don't make that much money and actually end up being worth over $1 million. So, as a 14-year-old kid, it's very exciting. And they talked about a few different investors. And it was, Warren Buffett was one of the investors they talked about in the book. So I bought a book on him called Warren Buffett Wealth by Bob Miles. And in that book, it talked about, the intelligent investor and common stocks and uncommon profits. And I just started reading the books that Buffett read when he was younger. And it just kind of opened my eyes to, the value of any asset is all the cash flows it will ever produce, discounted back to the present. It doesn't matter if it's a company or a royalty trust of some kind or a piece of real estate. So I would say that grounded me in investment principles. And I got very excited about it. And it was this game. Like I looked at it as a game that I love to play, and I started doing it for fun and researching and reading company reports. And then I started my company Granite State Capital in the end of 2014. I didn't get my first investor until 2015. And, just slowly been building that up over the last 5 years. And, that company specifically, we do investment management, for wealthy families and individuals. With stocks mostly. And it's a value investment philosophy. And then I started my podcast in 2017. There were not a lot of value investing podcasts at the time. And I had a blog years ago when I was in high school. So I thought, this would be fun. And I wanted to do something that I thought was fun, entertaining, but also could teach people because I really love teaching people what I do and helping people learn how to invest themselves. So that was a medium that I love, which I'm sure you love as well. The fact that you've done 75 episode 75. So that's pretty cool. Yeah. So you understand. So that's how I got into it. So that's a little bit about my background.
That's great. So in terms of the investments that you guys make, I noticed, on your website, you had quite a few investments in different industries, but there's obviously the one that stood out to me is the real estate. So can you talk to us a little bit about that and what you guys are invested in and focusing on?
Yeah, sure. So, I also, and for full disclosure, I do look at private real estate as well. So I have another business, Wyoming Warehousing and Safe Deposit Company, where, we have a small real estate portfolio, and then we also do consulting for investment managers and other people that would want to buy real estate themselves. But the principle, so I think this is what's interesting, and it's not really talked about a lot. The principles that I use whether I'm looking at a private real estate transaction or a public real estate transaction, are really the same. So, if I'm looking at a public company, or what's a public company? Because there's a lot of people, I've actually met this, I've experienced this, where there's people who, they're real estate investors and they're very logical and they clearly understand how to invest. And then it comes to the stock market and they're like, whoa, that's some scary stuff. There's stock prices moving around and that's gambling. Yeah, and the truth is, right, logically it's like their brain turns to mush. And it's no different, except the difference is if I was buying a piece of real estate and I'm the only buyer of the piece of real estate, it's like owning one share. It's like, imagine the entire company is a real estate company. It has one share of stock and you're buying the only share, and now you own 100% of the real estate company. The only difference is with a public company, you're often buying a portfolio or something representing real estate cash flows or real estate value in some way. And you're not the 100% owner, you're one of many shareholders and you own X% of the stock, but the principles are the same. So, we have a few real estate investments in Granite Capital Management, that are publicly traded. I could talk about maybe one or two of them if you'd like. I don't know how much time we have, but
let's do it.
All right. So one of them is a company called Brookfield Asset Management, and they're a very large company. Maybe I don't know the exact market cap, but 10 billion plus market cap company. So it's not like if you're even a mid-sized investor, you can't invest in it. I do like to invest in a lot of really, really tiny things that you really can't invest in it even with $100 million portfolio. But with Brookfield, it's it's very liquid, the stock, and the situation there is there's a few segments of the business. So there's an asset management company. So Brookfield Asset Management, they're an asset management business, and they specialize in both real estate and real assets. So it's a very interesting structure. The guy who runs it, and they would probably hesitate to say he runs it because he doesn't run the whole thing. He's just the CEO. But there's a lot of wonderful guys there that could step in his place if he was hit by a bus tomorrow. His name is Bruce Flatt, and he's a younger guy. He's been there for about 20 years, and maybe in his 50s now, which is relatively young for what he's accomplished over 20 years. The stock is compounded by high double digits, which you would know as investing in multifamily. If you could return 18-20% a year for 20 years, that's pretty damn good. So you could have invested in a stock that represents a lot of real estate investments and doing no work yourself, not having to worry about tenants. You literally have a management place. You could literally have bought the stock 20 years ago, gone to sleep for 20 years, and would have made more money doing that than your average piece of real estate. Now, the business model is really interesting. So they make money on the asset management side, right? So it's not pure real estate. You are buying an asset manager where they're making fees off real estate investments. They have a portfolio of private funds. A lot of those private funds are in real estate. And then they have a few publicly traded limited partnerships that they own large stakes in. So one of them is Brookfield Property Partners, which is a pure real estate play. So you may have actually seen Brookfield somewhere, in a mall or something. There's Brookfield Place in New York City, and there's also one in Toronto. So they're pretty big. They're pretty big in the real estate world in major cities all around the world. And what they do is they look to buy assets below replacement cost that they feel they can hold for a long time and make outsized returns. And they can make large deals very quickly. They can develop the properties, and they have a competitive advantage, especially when they're buying multi-billion-dollar assets. There's not many people that can just swipe up multi-billion-dollar assets very quickly and develop them. So obviously Brookfield Property Partners has been under a lot of distress, especially with their shopping mall portfolio. But so you look. So there's that. Then they have Brookfield Infrastructure Partners, which I think is most exciting. Bruce Flatt would say that we're in the very early innings of an infrastructure boom around the world. And even though their portfolio is in the many billions of dollars. Infrastructure is, people don't understand how large the infrastructure industry is. I mean, it's trillions, right? You're dealing with, bridges and toll roads and tunnels. And talking about internationally, you put a few billion in and you're only scratching the surface. So there's a significant runway of growth in infrastructure, even though it's already so large. Then there is the renewables business, right? So they're investing in, solar and power plants and all of that. And again, they're buying often distressed properties or properties where there's some, they were over leveraged or something, and they can, manage them better and get higher rates of returns than your average renewable investor that might be making, 3, 4, 5% cap rates. So that their cap rates are higher. And then they have, so I said infrastructure, property partners, renewables, and then they have one more, and I can't think of it. Oh, and they also have a private equity firm called Brookfield Business Partners as well, which is not real estate invested. So it's not that hard to figure out the business. You have to put some trust in management, but what you would do is you would value their real estate. They have a net asset value of the real estate, which you should value at net asset value, unless you think that they're overstating their assets on the books. They tend to have understated their assets on the books over time, because when they have sold assets over the last 20 years, they tend to get a premium to book value, not a discount. So that's always a good sign when you see management, under promising and over delivering and not being hyper aggressive on the balance sheet. And then you have to apply some kind of multiple to the asset management business. So, that asset management business, especially with low interest rates, has been growing like wildfire. So maybe you say you think it's worth 20 to 25 times earnings, something like that. And then you would take any extra carried interest from, performance fees that might be coming in, and you add all that together and you get a sum of the parts. And, we were buying Brookfield stock, literally 5 years ago at a pretty significant discount to, a relatively fair, value of what those business units would be worth. So yes, they have the asset management business, but then they have real estate, which you can literally look at and then value at a book value, and you would get a significant discount to where the stock price was. So that's just one example of, a form of publicly traded real estate. And if you wanted to even be a more pure play, you can look at, say, let's say you want to get exposure to infrastructure, right? Well, if I'm managing a portfolio of, a few $100,000, I can't necessarily go buy a tunnel with just, my own money. So infrastructure tends to be one of those industries where to buy it and to get those cash flows, you really need a lot of money. You're talking hundreds of millions to billions of dollars to invest in infrastructure, at least to get good returns. So Brookfield Infrastructure Partners is a way where you can invest in, it's structured either as a REIT or as a public partnership, depending on your tax laws in your country. And there have been times, especially say during COVID, where Brookfield Infrastructure Partners traded at a stock price that was completely inappropriate for the market value of that infrastructure. And it wasn't like that; those assets were impaired significantly from COVID, even though the market was down a lot. So that's an example of just one business that we're invested in. It's a pretty large position for us.
I see. So in terms of you kind of alluded to this as well. You mentioned obviously infrastructure is a huge industry, and you're basically owning pieces of the operating business of whatever you guys are investing in, and especially for that industry, just as a whole, it's going to take a lot of capital in order for it to be worth it and to see a great return on it, right? So I guess the difference, what do you see like the main differences between, I guess, the public returns and the private returns? Particularly, let's just use Brookfield as an example.
Sure.
Is it more of a longer hold? Because, usually the private deals, it's 3 to 5 years. Brookfield, obviously, and in the stocks, you can, buy and sell pretty much at any time. So what would you say is kind of the pros and cons to that situation versus the private deals?
Well, I'm not sure about the pros and cons, because you have to look at every situation on its own. Just like there's private deals that look very appealing. There's publicly traded land companies and publicly traded real estate that does not look appealing. So it's not like because it's public or because it's private, it's a good deal or a bad deal, right? It's just like, you know, if I'm looking at real estate in Texas and I think Texas is going to be booming over the next 10 years, it doesn't mean that any piece of property in Texas is going to be a good investment, right? So I'm looking at everything individually. When I look at Brookfield, I see a company that's going to be growing in double digits for at least another 10 years. And if I can buy that stock at a discount to what I believe those assets are worth in the private market, right? If I wanted to build, so this is how I think about it, right? If I wanted to build Brookfield from scratch, right? If I had, you know, a few, you know, billions and billions, you know, 20, $30 billion, and I just had the money to throw around to build a Brookfield, it would cost me more money to build Brookfield from scratch than to buy their assets in the public market, and a lot more money, you know.
Right.
So, and you could actually, I would refer you to, if you go to their investor presentation, of their most recent investor presentation, the management actually outlines how they look at net asset value of the company. And you can see right now, and again, you know, do your own due diligence. This is not a buy recommendation. Right now, the stock price, if you believe the management, which I personally do, the stock price trades at a significant discount to the sum of the parts of the real estate and asset management business of Brookfield. So if I believe, like I do, that the business itself is going to be growing at double digits, and I'm buying it at a significant discount to the fair value already, then my return should even be higher, you know, over the next 10 years.
Got it. Okay. So this is just one example. And so when you're generally managing, you know, portfolio, how diversified do you want your clients and yourself to be? You know, you invest in a Brookfield, and then what else do you invest in? Do you hold 10 stock, you know, heavy position stocks?
So right now I tend to be relatively concentrated. So, you know, I do have separately managed accounts. So every account's a little bit different, but I think right now it might be like 5 or 6 stocks, you know, over 50% of the assets that we manage. So, you know, in the context of most money managers, I'm extremely concentrated and not diversified at all. If I'm buying just, you know, distressed properties, I did purchase, for instance, a distressed pure play property company that is centered around grocery anchored, you know, retail, which is, you know, in distress, but not say as in as much distress as a non-grocery anchored retail. And that's a company where, you know, they're very highly leveraged. There is a chance they would go to zero. It's a 1% position, but I think the upside is, you know, 3 to 4 times my money in the next few years. So for something like that, I would not make it a large position, but a basket of those kinds of companies, I believe, would do very well over time. So anything distressed isn't a big position. If it's something where I don't really think I'd lose a lot of money, right? So, you know, as Warren Buffett would say, rule number 1, don't lose money. Rule number 2, don't forget rule number 1. My largest positions aren't in the companies I think I'll make the most money. It's the companies where I believe I'll lose the least. So, you know, another example of a business which is pretty much a pure play on real estate is a company called LACO, and it stands for the Los Angeles Athletic Club Corporation. They are a publicly traded limited partnership, and you know, again, do your own due diligence. Don't use market orders on this company. It's very, very thinly traded. There are days where no stock is traded in the company. And that's a business where, you know, they've been around since the 1880s. For listeners of yours that live in LA, they will know their staple asset, which is the Los Angeles Athletic Club, which is a big, very famous social club and gym that they have in LA. And the business has evolved over time through many iterations, and now most of their book value is in self-storage. And if you know a thing or two about self-storage, and I'd imagine you have a lot of real estate investors who are listeners, you know that the cap rates on self-storage tend to be pretty low today, especially in a low interest rate environment. And if you have really high quality self-storage, you know, you might be looking at cap rates of 4 or 5%. So why do I like Laco? Well, the vast majority of their book value is in self-storage, and then the other part of their book value is in the athletic club. So if I'm looking at how to value this business, I would say, okay, well, what do I believe the self-storage is worth in the private market? Maybe it's worth, I can even look at the public competitors, like Public Storage and Cube, and there's a few of these. And I can say, okay, these trade at, 4, 5, 6 cap rates. If I look at, LoopNet or any, real estate listing sites, I can see self-storage typically trading at, 4, 5, 6 cap rates. So I say, okay, that's generally the market. Laco has self-storage. A lot of it is in California, just a little bit outside of Los Angeles. They have some in Arizona, some in Houston. And so if I take the self-storage and then I add the athletic club, well, I can kind of get a sense of what the athletic club is worth because I can look at some surrounding buildings, and some transactions that have gone on in the area and say, okay, well, I think, in this part of downtown LA, buildings are worth, X price per dollars per square foot. And if I value the self-storage units at a private market multiple, I'm getting the athletic club for free. Another way of looking at it is if I value the athletic club at what recent buildings have been going at, which is, I don't remember the exact number, but these are, and by the way, it's probably worth more than what I'm about to say because a lot of the recent transactions are, an abandoned building, kind of a rundown jewelry store. I mean, things that are not nearly as nice as the LA Athletic Club. But if I'm going to be like extremely conservative to the point of, ridiculously conservative, and just say, well, it's worth the same price as an abandoned building that just got sold, even though this is a beautiful building and has a hotel in it and has a parking lot and has an undeveloped lot, which they can do something with in the future. Then the rest of the self-storage units are worth about are being valued by the market at, say, around a 9.5% cap rate, which you could argue one of the highest quality self-storage portfolios currently in the United States. They should not be going for a 9.5% cap rate. They should be going probably closer to a 4 or 5 cap rate. So I look at this as, the management buys back their stock a little bit every year. The management owns about 70% of the company. So they're very incentivized to do well for shareholders because most of their net worth is in Laco. They'll even say they pay their bills with the unit distributions dividends from Laco. So they're very aligned with shareholders and they pay themselves pretty low salaries. So that's always a good thing to look at that. So, again, if I was to buy an apartment complex, I want, the property manager to, not be getting paid 30% a year or something like that, right? So I say, okay, the Hathaway family's been at this for a while, and they pay themselves a really low salary compared to what they could with control of the company. So I have good management in place. They have a good track record of building wealth for their unit holders, not shareholders, who are publicly traded units of a partnership. And if I look at the valuation, in the private market, if I was to buy all that real estate privately, it would probably be worth, say, between $4,000 to $5,000 a unit. The stock currently trades around $2,000 a unit today. So even if I'm wrong, I have to be really, really wrong to lose money on that investment. And in the meantime, I get paid to wait, and right now the yield is about 4.5%, which is not bad for an unlevered yield. So that's one of those businesses where it's also a very large position for us. I expect it to probably slowly compound over time, and they'll slowly retire units. And at some point, the Karen Hathaway who runs it, she's getting up there in age. She's in her mid to late 70s. When she retires, there isn't anyone right now in the family that's highly involved in the self-storage unit. So, they might sell those self-storage portfolio to a larger buyer, which would make a lot of sense because they could, if they sold it to Public Storage or something, they could immediately cut costs. So Public Storage has an incentive to pay a little bit of a higher price for that portfolio. So, you could hold it for say 10 years, do okay, and then one day you wake up and the stock has, more than doubled. But if it doesn't happen, I expect to do, fairly above average, and, maybe make 8 to 10% a year on something with extremely low risk. And there's not many places where I can make a comfortable 8 to 10% unlevered, taking extremely low risk today. I mean, you look at, say, some pretty risky bonds that are trading at 6-7%. So I think for someone who wants to preserve capital and make some income, LACO is an interesting opportunity to look at. But again, do your own due diligence.
Excellent. So basically, to sum it up, you're evaluating public companies, you're reading their reports, you're evaluating the management, you're looking at the book value, and if it's trading at a discount. So it's very similar to evaluating private deals, if I put it that way. So it just a lot more research, obviously, and there's a lot more public knowledge that gets put out there.
And one correction I'll make is I'm not really looking at book value, because especially if a company has owned a property for a long time, just the way GAAP accounting works is the real estate is going to be on the books for what it was purchased at. So typically with a company like LACO, it's trading at a premium to book value, but I would say it's trading at a significant discount to the net asset value.
Got it.
Make sense? Yeah.
Got it. Perfect. That makes sense. So how can people find you? How do they find your podcast? How do people reach out to you to learn more about what you do?
Yeah, sure. So they can go to my website, which is ericschleien.com. And I don't know if you guys have show notes or something, but I could give you a link to that, and they can just click on podcast. If they want to look at my investment management company, it's just gscm.co, and they could take a look, and I have some case studies on there. And anyone can always contact me, and all my contact information is on there as well. And I'm also very active on Twitter, so I'm just Eric Schleien on Twitter as well.
Awesome. Well, Eric, we really appreciate you for coming on the show today.
Thanks for having me.
Yeah, I'm going to be linking your website and your Twitter and everything in the iTunes description, as well as in all our social media posts. For those of you who want to reach out to me, and then I can put you in touch with Eric. It always helps with a warm intro. Definitely check out my website, redknightproperties.com. Very easy to reach me. And then I can put you in touch with Eric as well, because he's got a lot of valuable insight that, I picked up on too. So thank you for our listeners. This is Discovering Multifamily Podcast, episode 775, and see you next time.